Hey guys, welcome back to another video. So today I'm going to be going over whether or not gold is a safe investment. In my opinion, I'm going to be going over some key points and then I'll show you some data. So first, going over some key points, reasons why people like to invest in gold is that they consider it to be a safe investment. They consider it to be a hedge against inflation because gold outperforms inflation usually. And then gold is a scarce asset, unlike cash or stocks or some other things that you might invest in. And then gold outperforms other assets during times of uncertainty. So just like right now, there's a lot of uncertainty about inflation, housing, war, all of that. So gold tends to perform really well during these types of times. Now, some reasons why you shouldn't invest in gold are that gold tends to underperform stocks in bull markets. It doesn't create value or produce income. So for example, companies that are publicly traded on the stock market, they usually create some kind of value. That's why people invest in them. And over time they grow and they create more value and they produce a lot of money. But gold doesn't do that. Gold is just a scarce asset. So it's the only reason why it increases in value over time is because it becomes more scarce. And then the last reason is that gold is taxed at a 28% tax rate. So whatever capital gains, long-term capital gains you get on gold, it's going to be taxed at 28%. And that includes gold ETFs. And this is in comparison to a 15% tax rate for stocks. And 15% is the average for long-term capital gains, which is over a year. By the way, don't forget to subscribe if you're not already. Now, the 10-year average return of gold and other assets worldwide as of June 2019, so from 2019 and then 10 years back, the average return of US stocks was 12%, whereas for gold it was around 4%. And then you can see cash was 0.5%, commodities were 4%, and then bonds were 3.5%. So recently gold has not performed that well against stocks, but this is because the stock market had been in a bull market for quite a while. Now, looking at a larger time frame from 1971 to 2019, you can see that stocks, US stocks, commodities, and gold, they basically all performed the same, all like over 10.5%, and then US cash actually performed at 5%, and then bonds at 6%. So this is really good from 1971 to 2019. It gives us a larger time frame, and you can see that if you had invested in any one of these assets, you actually would have gotten the same return. So, depending on whichever one you actually like, you could get a return either way. Now, looking at an even larger time frame from 1915 to now, you can see that the gold price versus the stock market, in this case the Dow Jones, which groups together the prices of the 30 most traded stocks on the New York Stock Exchange. The Dow Jones, since 1915, has actually grown by 60,000%, whereas gold has only grown by 10,000%. So, stocks have actually outperformed by 6 times, which is really, really significant because 60,000% compared to 10,000% is definitely no joke. And this is over, basically as far back as we can go. Now, if we look at this chart, it goes over bull markets and bear markets. So as you can see, the bull markets are in blue, bear markets are in orange, and then the recessions are shaded. So you can see oftentimes, even when we're in recessions, we actually stay in bull markets. It just kind of dips down a little bit and then we continue our bull market, but it doesn't go into, stocks don't go into a bear market. Now, here it says that the bull market on average lasts for 9 years with an average return of 480%, and then a bear market usually lasts 1.4 years with a loss of 41%. And, you can see on the chart that bull markets are definitely a lot bigger and they last a lot longer than bear markets. Bear markets seem to be very insignificant and sometimes they don't last that long at all. Like here, 6 months, 3 months. The longest that we've seen And this time frame on the chart is almost 3 years with a loss of 83% in total. But for the most part, you get really big gains. And so that just really shows you that between this chart and the previous chart, you can really see that investing in stocks is just a really good way to increase your wealth. Now, obviously, you can invest in gold. It's not like it performs bad. You know, as you can see here, it's increased by 10,000% since 1915. But if you're trying to really grow your wealth and not just kind of like try to preserve it in a very safe way, I guess you could say, then it's better just to invest in stocks over the long term. If you have plenty of time, then it would make sense to invest in stocks. For example, here, if you had invested in the year 2000, you would have seen a big downturn, and then you would have seen a rise up, and then a big downturn again. So, you know, in 2008, you would have actually been quite negative from your investment in 2000. But then after that, it's just look how much it's grown. And you can see here there was a dip too. Whereas for gold, it just hasn't grown that much. And sometimes it can take a really long time for gold to go back up. For example, if you had invested in this time frame right here and bought at the top, look how long you would have had to have waited for your return to just break even. So all this time you would have been negative unless you obviously just kept buying the dip, and then you'd probably break even a lot faster. But here for stocks, you can see the timeline for recovering your losses is just a lot faster. So for me, I think it's fine to invest in gold if you just want to diversify your portfolio quite a bit. But overall, it's better just to invest in the stock market. Anyways, just let me know what you guys think, and I'll see you next time.